What percent of a retiree's income should be taxable versus totally tax-free? I can show you how to have 40 to 60% or more of your retirement income not even show up on the front page of your 1040 tax return. It's totally tax-free. Yes, it's legitimate. The IRS will know you're receiving that money. They know everything. But it's totally tax-free, and it's been tax-free for over 100 years in the Internal Revenue Code. So get ready, because a lot of Americans have way too much money in taxable investments at retirement, such as IRAs and 401ks. I can show you what to do, which would be far better, so you will not outlive your money. So get ready. So I'm Doug Andrew, and I've been a financial strategist and a retirement planning specialist now for north of 5 decades, helping thousands of Americans prepare for a comfortable retirement. And one of the greatest strategies that I've helped these people with is converting much of their income at retirement to tax-free income so that they will not outlive their money. So when people ask, well, what percent of my retirement income should be tax-free? I usually recommend that at least 40%, up to 60% of your income be totally tax-free, not even show up on the front page of your 1040 tax return. It's legitimate. The IRS will know you're receiving the money, and they know everything. Some people, once they learn this, they want 100% of their income to be tax-free, and I've been able to help them do that by getting the taxes over and done with sooner than later prior to retirement on the money they have trapped in their IRAs or 401ks. So let me show you how this is done. I'm going to simplify this as much as possible. In the various books that I have authored, I've authored 12 books thus far. Been very blessed. They've all been bestsellers. And in my most recent book, The Laser Fund, which if you'll stay with me, I'll show you how you can claim a free copy of this 300-page book so you can learn to have tax-free income. But a lot of Americans draw income during their golden years from 1, 2, 3, or maybe 4 different sources. So let's simplify this. We have investment income. And this would be money in IRAs or 401ks that has not been taxed yet. It's been tax deferred, but that's usually invested in the market. It's the worst way to actually save, as I prove in my books, but 91% of Americans, I think, are duped into putting money into tax-deferred IRAs or 401ks, being told that you'll likely be in a lower tax bracket when you retire. And that has not been true or axiomatic now for more than 30 years. We'll come back to that. Now, some people have real estate. Yeah, I own real estate, but some think, well, I'm going to have rental income from my rental properties. Well, that real estate can go down in value during recessions, and it has done that several times in my career as a financial strategist. So I don't recommend that you should count 100% on rental income being there for your retirement. I'll show you the percentages that I recommend. Now, we also have a category that we call guaranteed income. Now, that could be Social Security if you feel comfortable with the government, guaranteeing you that income. It could also be a pension if you were a school teacher or a police officer or a firefighter. They retire with a pension, a defined benefit pension. And so that's guaranteed income. Some people, they don't really want to be rich per se. They just don't want to be poor. And so they might invest in an annuity so that if they run out of money, the annuity keeps paying them an income as long as they're alive. They just don't want to run out of money. That may be appropriate. The returns sometimes aren't as good as you could get otherwise, but at least it's guaranteed until you die, okay? Now, the most underutilized category is my favorite, and it's green because it produces more income and more money. That's the tax-free income category. And there's 3 general categories under that green box. And let's go into a deeper dive of these 4 places right now so you understand where I'm coming from. So when we look at this diagram, up here in the purple category, the purple bucket, most Americans have money in yet to be taxed IRAs or 401ks invested in the market. Wall Street was never designed to create predictable cash flow because of market volatility. It's the worst place to have money during your golden years, as far as I'm concerned, because you don't want to have to put off retirement 7 years like people did in the year 2000 because of the market crash in 2001 to 2003 after the 9/11 terrorist attacks. They had to wait 4 more years before they got back the money they lost until 2007. And then what happened in 2008? It crashed again 30-40%, and they had to wait another 4 years until 2012 to start taking income. If they took out income starting in 2000, they were out of money. 90% of their nest egg was gone by the year 2012. And so Wall Street was not designed to create predictable income. The sequence of returns is much better than the average return. What do I mean by that? From 2000 to 2015, in that 15-year period, your money in the market, let's say in the S&P 500, your average return was 7.5%. Well, that means theoretically, if you had $1 million nest egg in the year 2000 and you averaged 7.5% for 15 years, you ought to be able to pull out $75,000 a year without depleting your $1 million nest egg. But because people were retiring right at the beginning of 2 downturns in the market, those who did that, even though they averaged 7.5% between the year 2000 and 2015, their $1 million nest egg was dwindled down to under 100,000. 90% of their money was gone because of the sequence of returns. If you simply flip those years from 2015, let's say that was the year retired, 2014 was the second year, 2013 was the third year, you would have still had over 900,000 in that nest egg. The rate of return is the same, 7.5%. A lot of people do not understand that. So the purple bucket is where, frankly, 91% of Americans are way too top heavy with their money. And I have been teaching people for years at retirement planning is something totally different than maybe what you did for retirement. Most Americans for retirement put it in tax-deferred IRAs or 401ks. I think being duped. Oh, you'll likely be in a lower tax bracket when you retire. When they hit retirement, they're not in a lower tax bracket. Most savers are not in a lower tax bracket, okay? Why? It's because you have been killing your tax deductions throughout your earning years. You pay off your house. You don't have that mortgage interest deduction anymore. The kids are now gone, so you can't have that deduction anymore. If they move back in as adults, you can't deduct them as dependents anymore. And you're not contributing money to IRAs or 401ks during your golden years, so you don't have those deductions anymore. If you're a business owner and you sold your business, you don't have those deductions anymore. And Congress, because of irresponsible spending and the printing of money, most Americans agree that taxes in the future will likely be higher. Taxes are going up, okay? And so most people are not in a lower tax bracket. This is the worst place to have your money, and yet what do most advisors tell you to do? Oh, keep deferring. Procrastinate until you're age 72 or 73, and then take out RMDs, required minimum distributions. Why? Well, if you don't start taking out money out of these IRAs or 401ks by that age, there's a 50% penalty. 50% on top of the tax. The government wants their piece of that money. It's the best savings bond they ever came up with for themselves. You've had a permanent tax lien on your IRAs or 401ks. And so they want their piece of that money. And if you don't take it out when they want it out, it's a 50% penalty on top of the tax, okay? And so I recommend that you do a strategic rollout. You don't roll the money over from a 401k to an IRA and keep deferring. You're not saving tax. You're actually compounding it, okay? By stringing it out. I can prove that to you. And so I actually have software that shows people the darkness of the night. If they postpone and defer on their IRAs or 401ks until age 72, 73, and then take RMDs out to their life expectancy, their spouse's life expectancy, and then when they die, they leave it behind to their kids, and the kids have to now pay tax on it if they don't get it out within 10 years, you'll be flabbergasted the amount of tax you will pay. You're compounding the tax. Get it over and done with. Usually I recommend starting at age 59 and a half when there's not a 10% penalty, whether you need the money or not, get it out of there and get the taxes over and done with and reposition it down here to this green bucket. That's called a rollout, not a rollover, okay? A rollover is going from the frying pan to the fire. So I recommend at retirement that no more than 30% of your income, or maybe none of your income, be in those IRAs or 401ks subject to tax, nor market volatility, okay? So I can show you how to do that. It's one of the strategies that I came up with years ago, and I've helped thousands of Americans save $250,000, $500,000, $750,000, $1.2 million in unnecessary tax by doing a rollout. Watch other episodes on this channel to see those, and I'll give you a copy of my book where you can read these stories if you would like. Now, that's the purple bucket. That's where 91% of Americans have their money. Now, there are some people that have real estate. Real estate's okay. I own real estate too. And if you think, oh, wow, I'm going to have these rental properties give me rental income, well, there are time periods like 2008 when the mortgage meltdown happened. Some real estate dropped 30 and 40%. My own home in 2008, December of 2007, I could see the writing on the wall. And my house was valued at $1.5 million. And a year later, it was only worth $1,100,000. Now, because of the strategies I teach on this channel and in my books, I did not lose one dime of that $400,000, even though my house went down in value, because I keep my real estate equity separated over in a position of liquidity here in the green bucket, okay? But if you have your retirement income totally reliant on your properties having tenants and paying you rent, you better rethink your thinking. I recommend no more than 30% of your income be reliant upon real estate, because it can go down in value and you can have vacancies. And it happens. Real estate doesn't respond in a recession as quickly as the stock market does, but it does drop, okay? And so sometimes people, they get caught in those because of 1031 exchanges, and they don't want to sell the property and pay the capital gain tax. But if you have been paying attention, a lot of tax revenuers, they want to now increase the capital gain tax up to ordinary income tax rates, which would be double as of the recording of this episode. They even want to do away with the step-up in basis on long-term capital gains. And there are tax proposals that they now want to tax the capital gains that are even unrealized, that every year your real estate goes up in value. Whether you sold it and realized the gain or not, they're going to tax you on what it appreciated to. Well, what if it depreciates in the future? Is the government going to refund you the tax you paid? No. They want to take their money whenever they can get it. And so I don't recommend you think that this is the cat's meow over here. And you may want to rethink your thinking and get the money actually out of there. You can still own the real estate, but get the equity out and protect it so you don't lose it when the real estate values go down. I teach that on this channel, okay? Now, let's go down here to the orange bucket for a moment. The orange bucket is what we call the guaranteed bucket. And so it's a guaranteed income. Now, some people would categorize Social Security as a guarantee because the government is backing that. Well, Social Security, in my opinion, is a train wreck waiting to happen. But nonetheless, Social Security has a little cost of living increase each year, and that comes in a guaranteed fashion. We also have pensions and maybe annuities. Now, a pension is what somebody has if they taught school or maybe worked as a police officer or firefighter. There's a lot of large corporations like Harley-Davidson that still, I understand, gives their employees a pension. This is called a defined benefit pension. So the benefit is defined based upon years of service. If you were a school teacher in most states and you taught school for 30 years, you'll get 2% for every year that you taught school. 30% of what? Okay. Now, so what this means is you'll get 30 years of 2%. So 30 years times 2% is actually 60% if you taught for 30 years. Now, 60% of what? 60% of the average of your last best paycheck the last 5 years that you taught school, for example. And so, if you earned $100,000 a year, average the last 5 years you taught school, then you can get $60,000 a year on a defined benefit pension, or $5,000 a month. Okay. And so when you have a defined benefit pension, you can get $5,000 a month, $60,000 a year. That's if there's no survivor benefit. Most states will try to convince you to buy the most expensive life insurance policy you'll ever buy with no flexibility. They'll say, well, rather than take $5,000 a month as a pension, why don't you take a lower amount, like $4,000 a month, and then if you die before your spouse will keep getting that same income until they die. Okay, that's called a survivor benefit. If you say yes to that, you just bought the most expensive life insurance policy you'll probably ever buy with no flexibility. What do I mean by that? It means that what if your spouse dies before you and you get remarried? You can't share that with your new spouse. When you die, it doesn't go to your kids. They get disinherited. See, life insurance will go to a new spouse or to your children no matter what when you die, but not if the state gives you a survivor benefit. It's only if your spouse dies before you, it's only if you die before your spouse, okay? If your spouse dies before you and you get remarried, you can't name your new spouse as a beneficiary. A lot of school teachers don't understand that. I can show you a better way to take the full benefit and take the differential and put it into an indexed insurance contract, and you can access that while you're alive. But when you die, you will not be out anything, and you can change the beneficiary to a new spouse or your kids or your grandkids, whoever you want. They don't get disinherited like they do with a school teacher pension, okay? Now, some people have annuities. An annuity is a savings account with an insurance company, because insurance companies are rated one of the safest places to put money. But an annuity is only tax deferred, and when you start accessing money, it's now taxable. But sometimes annuities are there so that if you run out of money in the annuity, you keep getting an income based upon your LE, your life expectancy. The rate of return may not be that great, but at least you'll have an income the rest of your life. It may not keep up with inflation, but that's what some people do if they want a guaranteed income. Now, I don't own an annuity. I don't think I ever will, because I can outperform an annuity over here in this green bucket that's totally tax-free. Now, the tax-free bucket, the IRS knows you're receiving the money, but they know it's tax-free. It's not some loophole or secret. There are 3 general categories in this tax-free bucket. You might have some Roths, Roth IRAs or 401ks. Now, if you watch this channel, you'll quickly learn that I've never owned an IRA or 401k. I never will, but I've never owned a Roth IRA or 401k, and I never will. Roths came out in 1997 when the government was hard up for tax revenue, and they convinced a lot of people to roll money from this purple bucket, roll it over, not out, roll it over to a Roth. That triggered tax, and the government got a windfall of profit because they were hard up for money. They didn't do it for us, they did it for them. Now, it's a step in the right direction, but Roths only have 2 benefits. Your money accumulates tax-free, and you can access the money tax-free. Well, under my favorite vehicle, an MFTA, that's Max Funded Tax Advantage Insurance Contract, for over 100 years in the Internal Revenue Code, it's been a sacred tax-free cash cow. I can access the money tax-free. It accumulates tax-free. I can access the money tax-free, but I don't have all the strings attached that a Roth has. Roths, if you make too much money, you can't even have one. That's why a lot of savvy CPAs and tax attorneys refer to an MFTA IUL laser fund. And if you wonder, what is that? I can gift you a copy of the book here. In just a minute, I'll show you how to do that, where you can learn what it is. And it's totally tax-free, okay? It doesn't matter how much money you make. They call that the rich person's Roth. You don't have to be rich to have a laser fund. You can set one up and sock away $500 a month, but it's tax-free. In an IUL laser fund, I can put in as little as $500 a month. I could put in 50 or 200 or 300,000 a year. You can't do that with a Roth. Not only that, you cannot touch the money you put into a Roth for 5 years or till you're 59 and a half without a 10% penalty. I don't want those strings attached. I can get money, I can put 300,000 into a laser fund and 30 days later pull out 200,000. There's no 10% penalty, there's no tax, okay? I want that flexibility. With a laser fund, I get to use indexing where I get to make money when the market goes up but not lose when the market goes down. Most Roths are invested in the market where you will lose money when the market crashes, okay? The last benefit of a laser fund is it blossoms when you die. What does that mean? Anything I leave behind when I die increases in value. If I died tomorrow, I'm 72 right now. If I died in an accident tomorrow, every million I would have here in the green bucket in a laser fund would blossom to about 2 million and transfer tax-free to my spouse, my kids, my grandkids, a church, a charity, whoever. There's not a Roth around that'll do that. And people say, well, how much does that cost? Well, nothing's free, but it doesn't cost me anything. It's being paid for with a minuscule portion of money that would otherwise go out the window in unnecessary tax if I followed the herd and put my money up here in the purple bucket in IRAs or 401ks, okay? Now, you can learn about this by studying my book. Municipal bonds, they're not very popular anymore because a lot of municipalities are going bankrupt. They're not as safe as they used to be, and they're low yielding. My favorite by far is a laser fund. And so it's totally tax-free. I have taught advanced continuing education to CPAs and tax attorneys for decades. And I've always challenged them, show me any other investment vehicle in the Internal Revenue Code that allows you to accumulate your money tax-free and then be able to access that money tax-free so that every $1 million can generate $100,000 a year of tax-free income from age 65 clear to age 120 without depleting your $1 million nest egg. They've yet to show me anything else that does that. And so it's like the dream solution for many financial goals. So if you want to consider how can I get my money out of here or here or here over into the green bucket, and I would recommend that 40 to 60% of your income be totally tax-free. And I have helped people take $200,000 a year of taxable income that was coming out of these other buckets and get 60% of it, 120,000 of it, out of those buckets down here, and it's totally tax-free. And the rest of their life, they're only paying taxes on 80,000 of income, not the full 200,000. I saved them over $1 million of unnecessary tax the rest of their life. I do this all the time. And so if you want to look into this, here's what I recommend. First of all, study. Watch other episodes on this channel, but you can claim a copy of my book. Now, my book, The Laser Fund, has been flying off of the warehouse shelves. We send out thousands of these every month. Now, it retails for $20. You can go to Amazon and get it for $20 up to $60. If you do that, thank you. But I'll give you a copy free. Okay, it's 300 pages, but it's actually 2 books in one. This side is about 200 pages, 14 chapters with all the charts and graphs and explanations if you're a left brain learner. If you're a right brain learner and you learn more by the stories and examples, they're in there, but you can just flip it over to this one. This book is about 100 pages, 12 chapters with 62 actual client stories of how a properly structured laser fund knocks the socks off of these other alternatives, okay? If you want to use your whole brain, the left brain and the right brain, you can read both of these books. But simply go to laserfund.com or click on the link below. You contribute a nominal amount towards the shipping and handling. I require a little bit of skin in the game. And I'll pay for the book. I'll fire out a hard copy to you via priority mail. Now, while you're in there claiming your free copy, if you like to listen and learn or watch and learn, there's audio and video formats that you can invest in. But you can also schedule to attend one of our free weekly educational webinars. You can do that right there when you're claiming your free copy. You can even schedule an appointment with no charge or obligation with one of the top specialists in America that I have trained and oversee to see how a properly structured tax-free laser fund may work in your particular set of circumstances and how to do a strategic rollout. That rollout report is a value of $1,500. They'll do it for you free when you go in to claim a copy of this book. So go to laserfund.com right now, claim your free copy, and begin to convert your money from these 3 buckets down to the green one And I recommend 40 to 60% or more of your income not even show up on the front page of your 1040 tax return the rest of your life.